Building wealth is a mathematical process. While the amount of capital you save is the input you control, the final result is dictated by two massive multipliers: how much time you give your money and the rate of return you capture. But as an investor today, you are faced with an exhausting menu of choices. You have safe fixed deposits offering 6% on one side and highly volatile crypto coins promising 1,000% overnight on the other. Here is the absolute law of investing you cannot bypass. Higher returns always demand a higher cost, and you pay that cost in risk. Before taking on any risk to grow your money, you have to build a fortress around capital you already have. You must protect yourself against life's inevitable emergencies. Most families don't lose their life savings because they picked a bad stock. They lose everything because a sudden medical emergency or an unexpected economic halt forces them into crushing debt. If you try to build a towering portfolio without a secure base, the entire structure eventually collapses under the pressure of real-world events. Skip the liquid foundation, and your investment strategy becomes a high-stakes gamble with your family's survival. The first defensive pillar is life insurance. Many people buy endowment plans or ULIPs, believing they are getting a great investment combined with coverage. The math says otherwise. This table breaks down guaranteed return policies. High premiums for a ULIP rarely outpace inflation. Insurance and investments must remain separate. Pure term insurance gives massive financial cover for a fraction of the cost, freeing capital to invest. The second defensive pillar is the emergency fund. This is a non-negotiable pool of cash designed to cover exactly 6 to 12 months of unavoidable living expenses, like rent, food, and utilities. Here is the specific allocation. Keep 60% of this fund in fixed deposits, 30% in a standard savings account, and 10% in physical cash. You will not earn a high yield on this money, and that is entirely the point. Sacrificing yield here is the exact price you pay to buy absolute immunity, ensuring you never have to sell off your real assets during a crisis. To evaluate investment options, we use the risk-reward matrix. This chart maps expected return against the risk profile, ranging from zero risk to total ruin. In the bottom left low-risk category, fixed deposits and provident funds offer a predictable 6 to 8% return. Physical gold also belongs here. While prices fluctuate, it functions primarily as a consistent store of value, not a high-yield growth engine. The appeal of this low-risk zone is obvious. You get absolute capital preservation and a mathematically guaranteed nominal return without losing sleep over market crashes. But this bar chart reveals the hidden mathematical trap. If your fixed deposit pays 7%, but inflation eats 6% and taxes take another 1%, your net growth is exactly zero. Low-risk assets protect your money perfectly. However, they mathematically eliminate any possibility of actual wealth generation over time. Moving to the center of the matrix, we find the wealth-building engines, equities and real estate, sitting in the 10 to 15% return zone. Here, risk means volatility. It means enduring sharp daily price swings that eventually trend upward over time. This equation shows the rule of 72 in action. If a mid-cap mutual fund averages a 15% historical return, you divide 72 by 15. The math shows your money doubling roughly every 5 years. Real estate is the other option in this zone, offering an average 8 to 10% capital appreciation, but it comes with severe structural flaws that most investors ignore. Buying property requires massive upfront capital. The rental yields are a miserable 2 to 3%, and if you need money fast during a crisis, selling a house can take months. It is entirely illiquid. For most people, a portfolio of medium-risk mutual funds is the definitive path to generational wealth. You just need the discipline to hold through severe market depths over a 10-year horizon. On the extreme right is the hype zone: futures, startups, and crypto. High potential returns paired with maximum risk. Here, risk means absolute ruin, the probability of losing 100% of your capital. In futures and options trading, the statistics are brutal. 82% of retail traders lose their money because they are competing directly against algorithmic, high-frequency trading firms. Corporate bonds and early-stage startups operate on binary outcomes. If the company defaults or fails to find a market, your principal investment is instantly wiped out, regardless of the promised yield. Then there is cryptocurrency. It remains the ultimate volatile asset, driven almost entirely by pure speculation, rather than any intrinsic cash flow or hard backing. High-risk trading and startup bets are professional games with a statistical baseline of total loss, not a starting point for individual investors. The ideal allocation for the average investor is straightforward. Put 0% into high-risk hype assets. If you absolutely want to experiment, restrict it to a strict maximum of 5% of your portfolio as play money. This graph compares the math over 30 years. Chasing a 40% boom usually leads to a catastrophic drawdown, but compounding a boring, consistent 15 to 20% return quietly builds an absolute fortune. The actionable sequence is this: secure your health and term insurance first. Build your 6-month cash reserve in the bank. Then deploy the rest heavily and consistently into mid- and flexi-cap mutual funds. Executing this plan requires a psychological shift. You have to ignore the daily market noise, reject the urge to constantly trade, and let time do the heavy lifting. Achieving generational wealth does not require finding a magical 40% return. It simply requires optimizing for the highest possible return that completely avoids the risk of ruin.